Hey guys, and welcome back. Today I'm going to go through Amazon stock, and I'm going to tell you what I think everyone's missing when it comes to Amazon and why I think the stock is currently mispriced. So let's get started. Now, there's a lot of hype around what AI can do and the capabilities of it replacing human workers. But if there's one company in the world that will truly benefit from AI, it has to be Amazon. Amazon has one of the largest workforces in the world, second to Walmart. And it is one of the biggest costs to the business. And if AI was to truly replace workers, then Amazon will benefit massively from this. Now, Amazon knows this, and they're actively trying to reduce the amount of workers that they have. And we know this from a report internally from their automations team. So the report suggests that Amazon plans to not hire 600,000 workers that they would have needed by 2033. And on top of this, it states that they also plan to double their sales without hiring any more people. So what they're planning to do is to use AI to not only replace workers, but to also become more efficient. Now, if you do some simple maths here, if Amazon is planning to not hire 600,000 workers, and if we get the average salary for each Amazon worker, which is around 45k, times that by 600, divided by 10, then that means by 2033, Amazon could be saving 27 billion a year just from employment cost by making the company use more robotics. Now, Amazon have already started to use robots and find ways to make the retail side of the business more efficient. So let me take you through this graph, which depicts that. So we can see here that the company only really started making money in Q2 of 2023. And ever since then, their margins have been growing exponentially. And on top of that, their revenue has also been increasing at the same time. So not only is the business side growing, but also their margins and efficiency is growing within the company. Now, this is not just for warehouse workers, but also for corporate jobs. Just this year in January, Amazon announced that they were going to fire 16,000 workers from their corporate side of the business. This is due to the AI trade-off, where Amazon is planning to use these job cuts to fund their high AI spending throughout the year. Now, Amazon is a margins business, which means that the company has high amounts of revenue with high amounts of cost. What this can mean for the business is if they can just slightly increase their margins, then it means that the company could have a huge impact on cash flow. So I want to show you this graph which better illustrates that. We can see here that in Q1 of 2025, they generate 21 billion. And in Q1 of 2026, they generate 30 billion. And between that time, they added 3.4 billion from revenue growth and then 5.5 billion from margin expansion. This just shows that better efficiency is growing the business much quicker than the actual growth. Now, there's a new part of the business that's going live later this year called Amazon Leo, and that has not been factored into the price of the stock as of yet. Earlier this year, they bought this company called Globalstar, which was behind the iPhone's SOS system. So this just shows they already have a massive customer in line to use their service. And I can see massive demand for this. There's currently over 1.5 billion users of iPhones. And with the next iPhone 18 coming up, Apple plans to unveil 5G satellite internet, which will be run through Amazon Leo. And this is an absolute genius move from Amazon because this enhances other areas of the business as well. So for example, the AWS side of the business, what they can say now is we will provide you with AWS, we will do your logistics, and then we will provide you with secure internet into your remote facilities. Now, this is currently a great sector to be in because Amazon's biggest competitor is SpaceX, and SpaceX owns Starlink, which is one of the only parts of the business that is truly profitable. This gives Amazon Leo and Starlink a duopoly in the satellite internet. And to truly understand the demand from satellite internet, let's take a look at Starlink's revenue growth throughout the recent years. The year-on-year acceleration for Starlink has been huge. It's become a $20 billion industry and it's been growing 75% year-on-year. Now, in recent years, Amazon's ad business has been massive. Their ad business has some of the best conversion rates across the whole industry. And Amazon Ads has some of the best margins in the business. Last year, they generated $70 billion and 40% of that was pure profit. Amazon ads has been growing exponentially. The past 3 consecutive quarters, they've been hitting 20+% in growth. This is one of the reasons why Amazon can afford such large capex. So they've experienced 3 quarters of high growth, but let's understand why they've actually managed to do this. Now, Amazon have some of the highest conversion rates when it comes to advertising. And to understand this, let's first understand the psychology of the internet. When you're on platforms such as Instagram or TikTok, you don't always go on there with the intent of buying. But when you're on Amazon, your wallet is much closer to the ad, which means that Amazon can charge more for their customers for advertising space. Amazon has also become pay to play, where if you don't actually advertise your products on the platform, then customers won't be able to see it. In early 2024, Amazon also turned Amazon Prime Video into one of the biggest and largest ad revenues for the business. They flipped a switch and instantly started showing ads on the service. This generated a huge amount of income, whether you're watching sports on the platform or watching movies. Everyone was being shown ads. Now, the last part of the business that I want to go through is their chips business. Now, Amazon aren't like Nvidia and AMD, where they sell chips directly to the market. Instead, what they do is they sell computing space on AWS for their CPUs and AI chips called Graviton and Trainium. And this has been massive for Amazon, because just recently they signed a 10-year deal with Anthropic, where they would be investing $100 billion into Amazon AWS computing space. And on top of that, they also signed an agreement with OpenAI to start using their AWS services. And the numbers behind the business are staggering. They're currently sitting at $20 billion in revenue run rate and growing in triple digits. Now, what makes this even crazier, recently Andy Jassy, in his 2026 letter to shareholders, stated that if Amazon's chip business was to be a standalone company, it would have a $50 billion annual run rate. And to put that into perspective, this would mean Amazon's chip business would be nearly as big as AMD, who are the second largest chip business out there. Now, Amazon's chips and Nvidia's Blackwell GPUs are not the same. They can't do the same task. But what this does mean for Amazon is that they can have these chips run at significantly less electricity cost because they are 50% more efficient. Now, this is a massive advantage for Amazon, because not only can they reduce their energy costs, but it means that they can reduce their pricing for their AI compute, which would mean that they would have significantly greater demand. Now let's take a look at the stock price and their valuation. They're currently trading at $272, and their price to earnings multiple is at 32. Now, I think this is very low for Amazon, because if you take a look at companies like Walmart and Costco, they're trading around 50. The reason why they're trading at 50 is because investors like the predictability of those businesses, and so they can guarantee cash flow. But I argue that Amazon is just as predictable as those businesses and growing exponentially faster than them. And Amazon has been trading sideways for a very long time because investors didn't like the amount of capex that the company was spending, much like the other Mag 7 stocks. However, Amazon have always been that company to reinvest back into the business. So I don't see this as a surprise to the company. But they're already showing that their spending is justified. There is massive demand for their chips. There is massive demand for AWS. And they're already showing that their massive advancements in AI and robotics is pushing the company's cash flows higher and higher through their marginal expansions. And this is why I don't think investors have truly captured the potential of Amazon's capex, because this is only being viewed in the short term and not in the long term. I think in the coming earnings report, they will showcase their margin expansions from this capex and the growth of the business, and soon the stock price will catch up to what everyone else has been missing.